Welcome back. In recent weeks, the market has been overwhelmed with noise, sudden price swings, bold assertions, and now AI-driven forecasts presented as definitive answers. Many people are quietly asking the same question, even if they won't say it publicly. Can an AI model truly help us grasp what's going on with XRP at this moment? Or is it just another layer of confidence masking uncertainty? That's exactly what we'll break down today. But not in the usual way most videos do. This isn't about letting AI tell you where the price will go. That kind of thinking is lazy and dangerous. AI does not predict the future. It analyzes patterns, probabilities, and past behaviors. The value isn't in the output itself. It's in whether the framework holds up when you test it against reality. And right now, reality is uncomfortable for many people. Markets aren't behaving the way late-cycle narratives promised. Liquidity is tight, volatility is high, and confidence is fragile. In such conditions, humans seek authority, something that sounds intelligent enough to trust. AI fits that psychological need perfectly. But here's the hard truth most creators won't say out loud. If you ask poor questions, you get poor answers, no matter how advanced the model is. AI trained on historical data will always gravitate toward historical averages. That can be useful or misleading, depending on how you use it. So instead of asking AI what XRP will do next, the real question is, what does the broader system look like right now? Does it support growth or contraction? Because price is a symptom, not a cause. Today's breakdown is about using AI analysis as a lens, not a signal. We'll examine how models like Grok interpret market phases, how that aligns with historical cycles, and where those conclusions intersect or clash with macro liquidity, regulation, and institutional behavior. If you expect hype, price targets, or shortcuts, this video isn't for you. But if you want to understand why markets feel stuck, why timing disappoints so often, and why XRP's role can't be judged like most speculative assets, then stay until the end. Because the biggest risk now isn't missing a pump. It's misreading the phase we're in and reacting emotionally when patience and structure are required. Most lose money not because they misunderstand the asset, but because they misjudge timing and context. AI won't fix that by default. It only helps if you already know what matters. Before we bring XRP into the conversation, we must address the broader market reality. Because ignoring context is self-deception. Markets don't move on hope, nor because an AI sounds confident. They move on liquidity, risk appetite, and policy. Right now, all three are under pressure. Structurally, crypto has gone through a clear risk-off shift. Whether you call it a bear market or not is almost irrelevant. What counts is capital has pulled back sharply from recent highs, volatility is up, momentum has broken down on multiple time frames. These aren't opinions, just facts. Bitcoin, like it or not, remains the liquidity anchor for the entire digital asset space. When Bitcoin struggles to hold gains, it signals tighter conditions downstream. That's why AI often starts with Bitcoin when analyzing cycles. Not because Bitcoin is perfect, but because it shows where capital seeks shelter amid uncertainty. When Grok analyzes past cycles, it doesn't see narratives or headlines. It sees sequences, expansion, excess, contraction, and stabilization. Historically, after a major peak, markets rarely resume uptrends quickly. They spend time digesting, unwinding leverage, and resetting expectations. That process is rarely fast or comfortable. Macro factors matter more than most admit. Interest rates remain restrictive compared to the last decade. Liquidity injections are limited. Central banks are cautious, not accommodative. Japan tightens policy, global bond markets strain, and economic data is uneven. All reduce risk appetite. Crypto isn't exempt from this. It's misleading to assume isolated bullish news overrides macro pressure. One positive headline doesn't reverse a liquidity cycle. AI weights this correctly because it's not emotionally attached to single data points. So when AI says markets are contracting or consolidating, it doesn't mean collapse is inevitable. It means the system isn't currently optimized for aggressive growth. That difference matters. Most losses occur when people mistake lack of bullishness for panic or temporary bounces for structural reversals. At this stage, patience isn't a personality trait, it's a risk management strategy. The environment forces players to slow down, reassess, and stop assuming every dip is a buy. Sometimes the opportunity is just preserving capital while conditions reset. Now grounded in the market's reality, the gap between retail thinking and institutional behavior is clear. Retail reacts, institutions wait. That's why AI frameworks sound boring to traders but sensible to allocators. When institutions see crypto in contraction, the question isn't when will price rise, but is the system advancing while price struggles? If yes, time becomes an ally, not an enemy. Grok follows this logic implicitly because it values structure over emotion. It knows weak price action often coincides with back-end development, custody solutions, compliance, regulation, and infrastructure upgrades. None excite retail traders, but all dictate future capital flows. Liquidity is the key variable. In expansion, liquidity chases stories. In contraction, liquidity demands proof. Speculative assets without clear utility bleed most, while infrastructure-related assets quietly survive. This isn't favoritism, it's capital preservation. Retail confuses volatility with opportunity. Institutions see it as a cost. When volatility is high and liquidity tight, professionals hedge or wait. They don't chase upside no matter how compelling the narrative. AI reflects this by projecting longer stabilization rather than quick reversals. Regulation is critical. Institutions can't move before legal clarity. They build exposure indirectly, test systems, and prepare operationally long before price moves. That's why waiting feels frustrating. Progress happens, but not on charts. Bear and consolidation phases aren't pauses in development. They're filters. Weak narratives, over-leveraged players, and poor projects get wiped out. What remains is scalable infrastructure ready for better conditions. AI analysis is most useful here, not for buy-sell signals, but to remind markets move in regimes. Treating all regimes the same exhausts capital and patience. Now that we know how institutions and smart capital interpret this phase, the next question is, where does XRP fit in? Why does XRP's role differ from most assets? Let's focus on XRP because many oversimplify or misunderstand its story. XRP is often seen through speculative lenses like other assets. That's wrong, not because XRP is better, but because it serves a different financial function. XRP's importance lies in liquidity movement, settlement efficiency, and interoperability, not short-term hype. That difference matters more in contraction than in bull markets. When liquidity is plentiful, everything rises. When liquidity tightens, assets with defined roles retain strategic interest, even if prices look weak. Institutionally, XRP is closer to financial plumbing than speculation. The XRP ledger prioritizes speed, low cost, and reliability in value transfer. This makes it a prime candidate for bridging liquidity between systems as tokenization and cross-border settlement become regulated and standardized. Indirect comparisons help. Bitcoin acts as macro asset and collateral. Ethereum offers programmable settlement and smart contracts. XRP is positioned as a liquidity bridge, a mechanism, not a narrative. These roles coexist. They don't cancel or compete directly. AI tends to recognize this because it tracks usage and system evolution rather than social sentiment. When Grok evaluates XRP, it doesn't expect hyped exponential growth. It notes times when XRP reacts to liquidity shifts and regulatory clarity rather than speculation. That's why regulation matters disproportionately to XRP. Institutions won't adopt settlement rails they can't legally use. Progress appears slowly, often invisibly, via pilots, partnerships, and back-end readiness, not price spikes. Retail often sees silence as failure. Institutions see preparation. The danger for individuals is expecting meme asset behavior during a de-risking market. That breeds frustration and bad decisions. XRP's thesis plays out over systems and cycles, not weeks. Understanding this aligns expectations with reality, not guarantees outcomes. XRP's potential depends on execution, adoption, and macro alignment, not monthly market mood. With this context, mindset is key. How to approach this phase without forcing conclusions or turning analysis into emotional conviction. So the real question isn't whether AI is bullish or bearish on XRP. That misses the point. The important question is whether you grasp the market phase and if your behavior fits reality. Tools like Grok help when used as analytical frameworks, not oracles. They highlight historical tendencies, durations, and patterns, but don't eliminate uncertainty. Using AI as instructions rather than context outsources responsibility, and markets punish that quickly. XRP remains a long-term thesis tied to infrastructure, regulatory clarity, and liquidity efficiency. That thesis doesn't move on hype cycles. It moves when systems are ready and capital has reasons to flow through. This often looks slow, frustrating, and anticlimactic until it's not. This phase rewards restraint. It rewards sitting with uncertainty without forcing trades or narratives. It punishes impatience, overconfidence, and the need to always be right. That holds true whether you use AI, technical analysis, or macro data. If conditions improve, liquidity returns, and regulations solidify, XRP will reflect that over time. If not, the thesis must be honestly reevaluated. Both outcomes require discipline, not belief. That's where we end. This content is educational only and not financial advice. Always research and consult licensed professionals before investing.